Good morning, everyone. It's a pleasure to have you with us this morning. So, as usual, as we did already a couple of times with Jean-François Robin, we are going to analyze the main issues for your businesses, for asset allocation, for the way capital markets will be functioning. So the main points are basically obvious in this time. So we have to speak about the determinants of inflation. So what's ahead in terms of inflation? Will we see inflation receding progressively, or will we keep high inflation on a continuous basis? Of course, this means that we have to look at commodity prices, transportation prices, semiconductor prices. We have to look at wage costs, that's the way labor markets function. We have to pay a lot of attention to the asymmetries here between the US and Europe. Then, of course, we have to discuss central banks. What are the objectives of central banks? What kind of constraints are they facing currently? And then it makes it possible to continue with our prospects for monetary policy. And then finally, we can conclude on the different capital markets. And as you will see, we'll pay a lot of attention to the big difference between the evolution of nominal interest rates and the one of real interest rates. So we'll exchange with Jean-François on these different issues. You can ask any question you want anytime using the chat associated with this conference. And of course, we will be, of course, absolutely ready to answer any question you may ask us during the course of the conference. So I will start with this first issue, which is the one of the determinants of inflation and the question of whether inflation is transitory or is more permanent. And of course, the first question mark is about commodity prices at large, including, again, freight prices, electronic prices. So what we see is that when you look at the whole set of commodity prices, you just can construct an aggregate composite indicator, which includes energy prices, metal prices, food prices, transportation prices, chip prices. And this aggregate index of commodity prices has peaked in September last year, 2021, and since then it's decreasing, which means that by the half of this year, on an annual basis, we will see this composite index of corporate costs starting to be in negative territories. And this is a very, very important factor. So Jean-François will give more details, but you see where it's from. It's from basically the stabilization of energy prices. Of course, today we have a big geopolitical premium, which is increasing energy prices, but basically they are very much flatter now. And since we see oil production starting to recover, especially in the US and also in OPEC, it might be the case that we see a slight decline in the rest of this year on energy prices. Semiconductor prices have already adjusted, and if you follow what the semiconductor industry is telling, they are really investing massively currently, and there's a debate in the industry about the risk of having excess capacity next year. Freight prices have come down, and you see here the Baltic Dry Index. If you take a container price index, it has decreased as well by about 50% already. Metals, it's a bit more heterogeneous, and we have a number of metals with much lower prices like iron ore and steel, but you see all the metals associated with the energy transition process are still very expensive and will continue to be so. And this includes copper, nickel, lithium, cobalt, rare earth, and so on and so forth. But again, if you just mix up everything, you end up with a conclusion that this aggregate commodity price index is now decreasing. And that by the end of the year, basically, it means that core inflation and headline inflation should be about the same. Jean-François.
I think what Patrick said is very important in our scenario of the declining inflation towards, well, below 2% for Europe and probably around 2.5, below 3% in the US. What we see is that everything which is linked to bottlenecks, it's a little bit like a traffic jam. It's painful, it's long, but at the end of the day, it disappears. And we see that especially for the Baltics, semiconductors included. Most of it should be disappearing by the end of this year, probably before that for many things. And Patrick showed the Baltic index for container prices. We see a kind of normalization already, and we are only in February, so even faster than we expected, and being on the optimistic side of things. So we see this normalization of commodity prices linked to the bottlenecks. And one of the additional reasons for that is that, once again, bottlenecks are like traffic jams, so it disappears. But as well, because we see a big slowdown of the global economy, the world GDP should be normalizing fast, in fact, this year. And take the US economy, we expect the US economy to normalize, to be around 2% of GDP growth by the end of this year. European economy to slow down from 5 to 4, Chinese economy from 8 to 5. So the world GDP should be normalizing after this V shape we have seen last year for most of developed countries. So this demand side of this bottleneck should be disappearing. So, like Patrick said, it means negative delta of prices. So it means that in the basis effect will be very, very powerful in inflation. What is very different is, as Patrick said, the commodity linked to the energy transition. And you know that with Joël Hancock and Bernard Dada, we are strongly following that. Natixis research has been on the top 3 worldwide forecaster for this metal. So please read what Natixis research is saying about that. And what we do look at very precisely is what is going to be structurally in demand going forward. We know that lithium, for instance, we expect the demand for lithium to be multiplied by 40 by 2050. We see lots of things. A lot of people are talking about cobalt, nickel, linked to or rare earth in the energy transition. But we see that, for instance, Renault and Valeo are developing already new generation of battery without rare earth into that with new technologies. So maybe cobalt included are going to be less in demand. Lithium probably, but lots of commodities are going to be different. Depending on the technological evolution that we see on the electrification of transportation. So we look into that, but the big picture is really much the following: a decline on major commodities because the demand side of these commodities is going to normalize. So going forward, and that's the core of the issue today, is are we going to see long-lasting inflation or is it temporary? Sorry to say again, temporary. It's difficult to hold this line, but we think it's going to be temporary by nature.
Now, of course, second issue, if you try to assess inflation, is to look at labor markets and labor costs. So I really want to start here with the very important asymmetry between the US and Europe. And you can look at that if you look at the labor force, which is exactly the same as looking at participation. So you see the dark line is the US and the blue line is the euro area. And I just added France, I mean, to see a even more extreme case. So you see it's an extremely important difference here. In the US, the labor force is still like 2% below where it was before COVID. And you see it's not really improving very much at the end of last year. And in Europe, you see that the labor force has gone above where it was before COVID. So, of course, when you look at the surveys, you see a lot of hiring difficulties, both in Europe and the US, but they're of a very different nature. In the US, they are really harming the capacity of corporates at the end of the day to hire more people. And when you look at the number of jobs, you see that in the US, it's still well below where it was before the pandemic. And in Europe, you see the number of jobs is about the same as before the pandemic. A country like France is above where it was before COVID. There's a very interesting research which has been done by the French government on the French labor market, showing that even though the surveys show that it's for French companies, it's very complicated to hire, to recruit. In reality, the number of vacancies has not increased. So in reality, it's more painful, it's more costly, probably takes more effort, more time to recruit now in Europe. But at the end of the day, again, the number of new hires is about the same as before. Number of vacant jobs is not above what it was before COVID. And it's very different from the US. So you got a really tight labor market in the US. There's a big decline in labor supply. You don't have a really tight labor market in Europe. In reality, it's about the same as before. And of course, the outcomes of that are very important because it explains why when you look at nominal wage growth, and again, in Europe, you got a big noise, which is coming from part-time unemployment. If you correct for the noise and you look at all the sectoral wage agreements which are being signed in Europe, you see that nominal wages this year will increase by about 2.5%. And in the US, it might be around 5% if you take the whole set of indicators of wage growth. If you subtract 1 point trend productivity growth in Europe, you end up with a normal, I would say, a trend level for unit labor cost about 1.5% year over year in Europe, and in Europe you end up with something like 3.5. So there is a major difference, which basically explains what you see if you look at core inflation. I've got core inflation are slightly above 5% in the US and already coming down and just above 2% today in Europe. So this big difference, which is a 2.5 point difference between core inflation, which is the same as the difference you've got between unit labor costs, is coming from this extremely important difference in the way labor markets function. Got a lot of people in the US who left the labor markets, and you don't have that in Europe, just the opposite. In Europe, you got more people joining the labor market than before the crisis.
You will see that's very important because it's behind the scenario of saying that ECB is not going to be mirroring what the Fed is going to do. Once again, what Patrick is saying, that being a little bit conservative, maybe it's a little bit more than that, it remains to be seen, but let's say it's 1% productivity growth for a structural trend in Europe. If you end up with something like 2.5 wage growth in Europe, you can see that the core CPI and the headline CPI will be close to that, should be around 1.5. So we put a little bit more into that, and we end up with a figure for inflation, headline inflation in Europe, around 1.7, 1.8 maximum for 2023, 2024 in Europe. And we are exactly on the same page of the IMF, the OECD. Everybody is forecasting the same kind of figure for Europe in 2023, 2024, sorry, well below 2%. So if you look into that, the ECB has no big reason to do what the Fed is doing. On the contrary, this story in the US is very, very, very different. Big question mark on the US remain what is going to be the participation rate at 61.9. It seems to be stabilizing at very low level, this great resignation story. Question is around, is it going to stay there, or do we start to see some people going back into the market? Last NFP report was showing some kind of slight improvement in the participation rate, which seems to be logical since the child allowances stopped in December. And a very recent paper by the IMF is showing that the bulk of the explanation of the great resignation is coming from low-skill people, and most of it is due to women staying at home for childcare. So probably all this blind together, we shall see maybe a little bit of participation. But the big picture remains very different between the US and Europe, where in the US, the structure of the labor market is way different to Europe, where we all see this equivalent of the U6, the bigger picture of the unemployment market in Europe. We see that we are around 12-13% of unemployment rate, and because we were mentioning France, where employment is at it's the highest in 50 years in terms of participation, while in Spain and Italy we see unemployment still there. So there are big differences, but overall in Europe we have a lot of people still on the labor market willing to join the labor market. Very different story in the US.
So just 2-3 additional points here. I mean, we've got to understand where is the big increase in commodity prices, transportation prices, chip prices coming from. It's not from GDP itself. When you look at the level of GDP in the OECD, it's just about the same as before COVID. So there's no real recovery. It's not the strength of the recovery which is explaining the big rally in commodity prices. It's a composition of demand. We have a very, very significant and impressive shift in the composition of demand from services to goods. If you look at the consumption of goods and services in the OECD as a whole, consumption of goods is up 27% in real terms in the last 2 years. Consumption of services is down 1%. So this big shift from services to goods explains the very big increase in the demand for energy, metals, transportation, chips, semiconductors, whatever. And so if you want to assess the speed of disinflation, you also have to assess the speed at which the structure of demand will normalize. We see today that the demand for services is catching up. Demand for goods is weakening. Got a transitory component in the demand for goods, for instance, where people with home working buy a new computer, they do that just once. So a part of that is transitory, and then we'll have a normalization. A part of the additional demand for goods will be permanent. Think of what's linked to energy transition. You need more windmills, you need more grids, you need more hydrolyzers. So this will be more permanent, but a part of that will correct. And of course, the faster demand goes back to services, the faster commodity prices will come down. The second thing I just wanted to add before we move to the next point is the question of productivity. So you see a very different pattern for productivity. If you look at jobs, the number of jobs is still very low in the US, and you had a big improvement in productivity in the US. Part of that is probably attributed to digitalization, to home working, to e-commerce, and then companies having to digitalize. And in Europe, you see productivity has been extremely flat. In countries like France, it's been coming down. So how can you explain that? The main explanation is the nature of the new jobs. When you look at the nature of the new jobs in Europe, it's very, on the one hand, of course, you've got IT jobs, complicated jobs, that very small number actually. You got a very large number of new jobs created in personal services, in very basic corporate services for corporates like cleaning, of course, in transportation, in logistics, and these jobs have very little personal productivity, which is explaining the weakening of overall productivity in Europe. Now, just I start with the third point, and Jean-François will continue. I just want to draw your attention to a very important issue, which is the issue of profit margins. Basically, if you've got more, and I just skip 2 or 3 slides, we'll be back to that. I want just to look at this one here. If you look at the composition of inflation, you've got 3 possible components. Inflation can come from labor cost, from commodities at large, including transportation and the rest, and from higher profit margins. If companies increase their prices more than the increase in their cost, of course, profit margins widen, and then it's inflationary. And you don't have that in Europe. Here you've got real earnings, which is exactly the same information as profit margins. You see, look at the blue line, you see that real earnings in Europe are just back to where they were before COVID. They're basically flat compared to the last 2 years. So there is no additional inflation in Europe coming from profit margins. And you look at the US and you see this incredible increase in the real profits, which corresponds to a massive increase in profit margins, of course. And this is very inflationary. So when you decompose Eurozone inflation, you've got a bit more than 5% inflation in the euro area. About, I would say, 2.25 comes from labor cost, and about 3 points come from commodity prices at large. When you decompose inflation in the US, you've got 7.5% inflation, about 3.5 come from labor cost, 2 points come from commodity prices, and more than 2 points come from higher profit margins. So if not for higher profit margin, inflation in the US would be like 5%. So the big difference between Europe and the US is not only the labor market, it's the reaction of corporates. We've got US corporates are really increasing massively their margin, and this is very inflationary. Just to finish on that, and then Jean-François will comment on that, of course. This is a massive problem for the Federal Reserve because this is very bad inflation. If you've got inflation coming from more demand, it's a form of good inflation. If it's coming from energy prices, central bank cannot do a lot about it. If it's coming from higher margins, this is a very big issue because it's very bad inflation. It's coming probably from very much like, as you know, in the US, concentration of companies, oligopolistic power. This is extremely bad source of inflation, and this is one reason why the Federal Reserve might want to be very much more aggressive than the ECB.
I think that's very important, is that central banks today are facing mostly a supply side shock. It's more than a demand side shock. Even though the demand was a little bit higher in US, again difference in Europe that's not the case. And the demand is back to where it was pre-COVID, but not above. So there is not an explosion of demand so far in Europe, especially, and it's a supply side shock. You can hike rates as many times as you want. You are not going to solve the problem of semiconductors, of gas prices, of the regulation of the harbor of Los Angeles or the closure of Chinese harbors due to the zero COVID policy. So you can hike rates. It's not going to solve this issue, which are at the origin of this bottleneck. So what central banks are doing basically is just making sure you are anchoring inflation expectation. But there again, you have a very, very big difference between US and Europe, where this spiral between wage and inflation, you have some more credit to this story in the US compared to Europe. And what we see in this very interesting graph is that usually the share of labor cost in the real earnings was diminishing, but there is a structural change of late in the US, and that's probably something lots of economists have published about in the US, this oligopolistic side of things and the pricing power of big companies. You cannot negotiate your wage with Amazon when it's the sole employer in your region. Marinescu, for instance, a French economist based in the US, has done very interesting work on that. You have some pricing power with this big company, with lots of monopolistic in the US, which is not the case totally on the contrary in Europe. So this is very, very different story once again. So just to make sure that to make the link with markets and our scenario, when the market is copy-paste what's priced in the US yield curve to the Europe, it's not going to be the same at all. It's the dynamics for inflation in Europe is to be below 2%, where we might see this spiral wage inflation. There are lots of you have more possibility in the US definitely than in Europe.
Now, if you want to assess central banks, and this is what we are heading for at the end of the day, we have to look now at the environment in terms of growth, because of course, if growth becomes weaker, this is making it more complicated for central banks to normalize monetary policy. So what should we think about growth in 2022? Well, I think we are concerned by a number of developments. One, of course, is that real wages diminish. Take the US, nominal wages increased by 5, inflation is about 7, so it's a more than 2 points decrease in real wages. In Europe, you've got nominal wages up 2.5% in 2022. Inflation is now is above 5, so it's again a more than 2.5% loss in real wages. So this is probably a big shock to the consumer. A number of people think that it will be offset by consumers spending their accumulated savings during the crisis. I'm not sure this will happen because, as you know, these excess savings belong to the 20% richest individuals, which have a very, very low propensity to consume, and they will be more investing these savings on different markets. So I think we may have a weakening of consumption. This is already starting, probably. Then, of course, and this is something which is very, very important, we have a very big reduction in budget deficits. And if I look at the structural deficit, which is corrected for the cycle, you see that nothing basically happens in Europe, and the euro area, the structural deficit is about flat. If you include the public spending coming from the EU, from next generation EU, you end up with an extremely neutral fiscal policy in 2022 in Europe. And you see this extremely rapid shrinking of the budget deficit in the US. It's like a 4-point decrease in 1 year is a structural deficit, which is the largest we have seen for many decades. Of course, Jean-François mentioned that already, we have weaker world trade because of this very, very much weaker Chinese economy, with a big problem a number of emerging countries are facing. So the environment is an environment of slower growth. Jean-François will just give you a flavor of what we think in terms of actual growth this year. In this environment, central banks find it more complicated to be very aggressive, of course. So in a minute, we'll discuss central banks. So basically, I think you've got add up A, lower commodity prices starting and continuing, B, not really a problem with core inflation in Europe, but yes, a problem with core inflation in the US because of what's going on in the labor market. C, this very big shock, inflationary shock coming from higher profit margins in the US, which we don't see at all starting in Europe. And D, weaker growth, especially in the US with this extremely severe fiscal tightening. And this is basically the framework for monetary policy choices this year.
looking at growth or scenario, it's very much one of normalization. And 2022 is a start. We get out of this V-shape recovery of last year. Overall, because once again, emerging, all these countries with zero COVID strategy are going to remain in this COVID story much longer probably than the country fully vaccinated with working vaccines, and totally different strategy are going to end up with totally different outcome in terms of GDP growth probably. But the big picture is the following: US economy, a massive deceleration from 6% GDP growth Q4 2021 to probably something closer to 2%, so that divided by 3. Once again, if you have wages lower than inflation, you are losing some purchasing power in the US. You are going to see probably rising unemployment in the US, and at the same time you have, like Patrice is showing, a big decline of the budgetary stimulus. You have a big normalization of interest rate. You start to see a decline in real estate prices and stock prices. So the wealth effect is going to be there as well. So all that together, you can totally explain this strong deceleration of consumption. We can imagine a zero growth Q1 in the US, a very strong deceleration of consumption. And look at the retail sales, they were negative in December already. So in this context, in our view, we are going to see a strong deceleration of US economy. Consumption is 70% of GDP. Once again, Joe Lavogna, our chief economist for Americas, is saying, well, you cannot put 7 or 8 rate hike in this context. Otherwise, you will end up with a recession in the US probably. So strong deceleration of US economy. Like I said, Europe from 5 to 4%. We are a little bit behind in terms of timing. So we are just out of this V-shape. So France is already above its pre-crisis level, around 1 point of GDP above 2019. But that's not the case of Italy. That's not the case of Germany. Not the case of Spain. Not the case of UK. Not in Europe, but a similar situation. So you probably have some catch-up again in GDP growth. But still, the big picture is from 5 to 4, around 4% this year in Europe. China, very strong deceleration, and Alicia Garcia Herrero is saying that basically all the engine of growth in China are at full stop. Investment, consumption in China is almost zero. You have just 2 remaining engines, which are the usual suspect, which is exports, and probably some stimulus coming from the central government. But at the moment, the central government deficit is half of what it should have been. So we have a big story where the central government has some trouble spending its deficit because of all this Evergrande, all this way of financing the spending in China, which is at full stop. So very strong deceleration of China from 8 to 5%, but without this official stimulus budget and monetary, probably the underlying growth, the potential growth of China will be much lower this year already. This is the anniversary of the Communist Party. This is the re-election of Xi Jinping. No way it's going to be well below 5%, but still from 8 to 5. So world GDP is decelerating. So it's why we have this scenario of normalizing commodities, of inflation or second round effect of inflation, probably normalizing going forward. So I dare to say we are still a little bit on the temporary camp regarding inflation, and then we are well below consensus regarding central banks that we are going to discuss now.
Now let's move central banks. Now we have the basic pieces to think about central banks. So what are the markets thinking? Markets are thinking this. When you look at the 3 months contract, you look at different information. But Federal Reserve will be tightening, of course, will be hiking. You see, well, like 5 times this year, and we'll have a terminal rate like 2.5%. And the ECB, the market still think that the ECB will hike twice this year with a terminal rate like 1%. So now, before just concluding on what we think, which might be different, I think we've got to spend a minute looking at the difficulties for central bank. Now, there is a short-term difficulty, and we just discussed that, but you cannot have everything tighter at the same time. So if you've got low real wages, a tighter budget, slow growth in China, negative wealth effect because of what's going on the equity markets. If at the same time, the same year, you tighten monetary policy a lot, then you will end up with a recession. So you cannot do that. You cannot have everything being tighter the same year. So I think this is a short-term argument that we'll be making, and this is really the argument Jean-François just developed. We'll be making central banks, especially the Federal Reserve, less aggressive than what a number of market participants believe. And B, on a more structural basis, I think we have to think that central banks have many objectives. We can even think that they have too many objectives. They have, of course, fighting against inflation, financial stability, which they don't really care a lot about. But then they have maintaining the solvency of the government, the sustainability of public debt, stimulating growth. Christine Lagarde mentioned here in Paris, I mean, two weeks ago, that the strategy to reduce debt ratios was to have more growth. So if you have more growth to reduce debt ratios, you don't use tighter monetary policies. Investment in energy transition require very low interest rate because they have very low financial returns. In the US, as you know, the Federal Reserve is interested in the number of jobs created, in inequalities, in inequalities between the different minorities in terms of access to labor market. And of course, the basic question Jean-François just asked, which is how should central banks react to supply shocks, not to demand shocks? And we have mostly a supply shock, both labor markets, commodities. So when you take all that into account, you have so many objectives that central banks have to find a compromise. These are conflicting objectives mostly. If you want to support potential growth, you cannot fight very much against inflation. So I think central banks have many, many conflicting objectives. And the normal outcome is a compromise, which means that they react little to the shocks. Now, just to close on that, and then I give the floor back to Jean-François. Well, we just said that the ECB did not have a real problem with inflation. Again, by far, today, the most likely scenario is that inflation will be below 2% in Europe next year. So this is not that much a problem for the ECB. It's a big problem for the Federal Reserve. Core inflation might be still well above 3% next year in the US. So, but if the Federal Reserve was really decided to fight against inflation, they would have to raise rates above the level of inflation. You need to have positive real rates if you want to fight against inflation. If you think that inflation by the end year will be like 4%, it means that Fed funds should go to 5-6% if you really want to have a real effect on inflation. So whatever the Federal Reserve is thinking about doing, it's not going in that direction. So we have a very mild reaction of central banks. And in reality, central banks are not fighting against inflation. When you keep negative real rates on the trajectory ahead, you don't fight against inflation. Again, fighting against inflation would require a much more severe tightening of monetary policy. So it's very much, again, communication, telling to the capital markets and to politicians, okay, we are serious people. So we care about the increase in inflation, and it's very much, again, finding a compromise between all this very wide set of completely conflicting objectives. And again, if you are interested in inequalities and creating jobs, you cannot really fight against inflation when it happens.
So what are our scenario regarding central bank? If we look at the US first, once again, Joe Lavorgna has looked at the last 8 cycle of interest rate hike by the Federal Reserve, and never ever the Fed is hiking rates when consumption and confidence of households is on the decline, which is the case today. So once again, what Patrick is saying is very at the core of our argument, is that what the central banks are doing confronted to a supply side shock mostly is more or less anchoring inflation to show that they are not that behind the curve. But they are very, very pro-cyclical for the US. The Federal Reserve is very pro-cyclical. You are already facing a strong deceleration of US economy, a strong decline of consumption, and you are hiking rates. This is very rare in history. So we are not far from a stagflation dilemma for the Fed in this regard. So in our view, no question they have to deliver in March because they said so. So we have a credibility issue if they are not doing so. Again, unless we have something in Ukraine, you are not hiking rates. My view is that we are not hiking rates in war times. But if you take that aside, they will deliver a rate hike in March and probably followed by another. But by the second part of next year, we shall see this deceleration. And in our view, well, maybe the Fed is going to wait to see what's going on. So once again, the market pricing of 8 rate hike this year are way too pessimistic in our view. You will end up close to a recession in this context. So a couple of rate hikes, and we shall see what's going on in the US economy to see for the future. For the ECB, it's much more simple. And once again, the market pricing seems to us quite too pessimistic for the ECB. For the ECB, what they want to do, once again, they're not confronted to a medium-term inflation, wage inflation spiral either. So they have time in a way. They don't want to rush into hiking rates. And third, they want to respect the sequence that the ECB, Lagarde repeated, and many governing councils said so as well. They want to end up the quantitative easing first, so the HS purchase program, they have to end up that first. So at the earliest you can imagine is probably June. They can announce that in March, but it's June and most likely September in our view. So you end up with a potential rate hike in December, but not before. And look, all the market was jumping around looking at what Knot is saying. Okay, Knot is the most hawkish guy from the ECB, and even the most hawkish guy of the ECB is saying, well, I can imagine a rate hike in December and another one in June 2023. So the market pricing of having a rate hike in June, sometimes a little bit before, another in September, another in December, is way ahead of itself. I think the ECB, it's not at all the same situation than in the US in terms of anchoring inflation. And when we look at the 5-year, same story in the US, by the way. We do not see a big disanchoring of inflation expectation in the US. And look at yesterday, the Fed indicators of inflation expectation is on the decline already. So watch out, the market pricing is way too pessimistic or optimistic in our view, both from the ECB and from the Fed. And the Bank of England, it's a bit of a go-between. They shall deliver another rate hike, but after that, it will be the same story, a little bit more difficult. What is very, very different story, and once again, you see that 2022 is a year of normalization, but as well, the year of not decorrelation, but clearly a year of idiosyncratic situation regarding central banks and economy. The central bank, the PBOC, the Central Bank of China, is clearly going to keep delivering some loosening financial condition. They already did that this morning. So relaxing the credit in China, while in Japan, the Bank of Japan, and Japan economy is still accelerating, a little bit like in Europe, still on this catching up side. But the Central Bank of Japan is already saying, I will do a kind of whatever it takes to keep my maximum 10-year yield unchanged. So you have a very different situation, but overall, the market pricing is way too pessimistic in our view. So a couple of rate hike in the US versus 8 priced in, probably 1 in the ECB compared to 2, maybe 3 in the market pricing, depending on the days.
2-3 additional comments. One, on the instruments of monetary policy. I mean, as Jean-François said, the ECB keeps the idea that you have to first exit QE and then only start hiking short-term rates. This is not clear that it has to be the case. You've got really 2 completely different instruments. Short-term rates, they just move the average level of rates, and QE or QT moves the slope of the yield curve. So you could very well decide to hike rates and keep buying at the long end. And this is something which is very interesting because basically, if you think central banks are in a very much complicated situation, they want again to fight against inflation, but at the same time, they don't want to kill the economy, they want to kill investments. One possibility would be to invert the curve. So we'd have higher short-term rates. That's weakening the cyclical part of demand, and this is having an effect on inflation. But you keep low long-term rates to keep having a stimulation of investment and long-term growth. So inverted curves could be a solution for central banks. And this is something which starts, as you know, being debated in the US as a possibility that we end up with an inverted curve. In Europe, of course, it's very much less likely, A, because you don't need really to fight very much against inflation, and B, because it would be killing the banks in Europe, which also inverted curves in Europe are very, very bad ideas for the banks. Last thing, the slope of the yield curve is absolutely not an indicator of future growth. It has nothing to do as a leading indicator of future growth. So an inverted curve is not at all indicating that the economy will go into a recession in the future. Just stopped working that correlation in the 1990s. Last thing, before we move to the markets, just let's have a look at long-term rates. Just very briefly, just to remind you that Federal Reserve already in the past tried to shrink its balance sheet in 2018 and early 2019. You see that on this chart here. That's base money, so that's the balance sheet of central bank. And remember that in the spring of 2019, it turned extremely badly. You had a massive widening of credit spreads, a massive correction on the stock market. PMI started to decline. And then even though the US were completely at full employment, Federal Reserve had to restart QE. So the experience of QT, of a quantitative tightening in the US is not a very good one. So I think we have to keep that in mind. It's a possibility that at some stage, the Federal Reserve has to stop QT because of its very negative effect, especially on dollar liquidity. And last thing, because I give the floor back to Jean-François, if you look at now, just two last things. Currency, you've got a very extraordinary situation, and Jean-François just described it, where central banks decorrelate. So you will have a tighter monetary policy in the US and not that much a tighter monetary policy in Europe. And a number of people are worried that this could cause a big weakening of the euro vis-à-vis the dollar. Now, Fiori just tells a story which is consistent with whatever been observing. I mean, if you look at currencies, when the markets learn that a central bank will be more restrictive than another one, the currency of the country with a more expansionary central bank depreciates very rapidly, and then it starts reappreciating very slowly just to bridge the gap between interest rates and to equalize the returns in the two currencies. That's the very famous model by Rudiger Dornbusch in the 1970s. And we have that. Last year, as you see here, we had a very much weaker euro, and the euro loses like 12 figures. And this is an expectation of this asymmetry between monetary policies in the two countries. And then now it starts reappreciating slowly. And I think we'll have this slow reappreciation continuing. It's completely consistent with Fiori, with the ECB in this environment where the ECB keeps a much more expansionary monetary policy. And last thing is just, if you look at, just back to rates, if you look at nominal interest rates, which I have somewhere here, sorry, you see the markets are expecting a very, very mild increase in long-term interest rates. And so we have something we have to explain, which is the rigidity of long-term interest rates. Long-term interest rates underreact very much to inflation, for instance. So why do we have this rigidity? I think you have many causes. One is that the markets still believe that central banks will be prudent. B, Jean-François just mentioned that the markets still believe that inflation is more, at least there's a big component of inflation which is temporary, not permanent. And C, remember that we have a lot of buyers of safe debts. We have foreign non-resident buyers. We have a lot of people from abroad investing in government bonds in the US and Europe. That's mostly foreign central banks. And we have domestic investors who are forced to keep investing in government bonds because of regulation. So there is a very strong structural demand for safe debts. So at the end of the day, we build up a very big rigidity of long-term rates compared to the volatility of inflation, for instance. Perhaps we can move to the different capital markets, Jean-François?
Yes, sure. What Patrick was mentioning is that this normalization of monetary policy is very important in the scenarios that we are having for markets, obviously. And what Patrick has said is very important to us, is that when we look at the decomposition of the impact on rates of monetary policies, we see that the stock is much more important than the flow. So at the end of the day, if central banks are very cautious in selling out their position even including the Fed. We agree with the fact that the Fed might be doing some quantitative tightening, QT, by the end of this year, but that will be very gentle. So probably the same way they did in 2018, having some cap on the maturing outstanding of bonds that they let mature without buying back some of it. So probably some caps, so very gentle, very something under control by the Fed. While in Europe, probably it's not before the end of 2024. Once again, the sequencing of the ECB is you stop the purchase program, then you hike rate, and then you stop reinvesting your maturing bonds. So we are having again 2 more years of rising stock of QE by the ECB. So the impact on rates will be very, very different. And we calculate with Dirk Schumacher, our chief economist for Europe, the impact will be close to 100 BP for the Bund and 200 BP for the BTP. If we stop we unwind all this stock of bonds held by the ECB. So it's a very important thing, but again, it's not going to happen before 2024, 2025, probably for the ECB. So very different story. So when we come out, we take that all together and we look at our asset allocation. What do we say? In terms of level of rates, once again, we expect the US rate to be going toward 250, so not far from where they are, so 50 BPs more. Because the Fed is stopping the QE, because we have something a bit more inflation than before the crisis, and because we have a net supply. Once again, when your first buyer is there, it's not going to be there. But once again, something interesting there is that we still have some nominal illusion in rates. And when you have some 2% yield in the US, we have seen the flows from abroad going back to the US all of a sudden. So it's not very possible to imagine long-term rates going higher. And once again, what matters for the Fed is probably looking at the long-term rates for monetary conditions. So 250 around for the 10-year in the US. So still a negative total return going forward, despite the fact that we might have some flight to quality. For the Bund, we expect 0.85 before the end of the year. So there again, the ECB and its QE, some pricing of interest rate hike in the curve going forward. So probably the net supply effect, net of ECB buyings, is going to impact the Bund. Plus probably some structural changes from the German coalition regarding spendings, and we see that things are moving fast as well on this regard. But as well, think of something very important in our view, is that the HS purchase program is then the only tool for the ECB to fight the spread widening of sovereign. So it's going to be very, very gentle. So it's why we do not expect some of our competitors are starting to say, well, ECB might stop the APP in March or all of a sudden. No, because that's the only instrument remaining in the toolkit of the ECB. At the same time that you have the election in France, you have always some political situation in Spain, in Italy. We see all this Russian-Ukraine story going on. So no question for us, the APP is going to remain there for a while. So probably the impact on spread is going to be limited by the possibility, or at least the threat, of ECB stepping in. In terms of equity market, the obvious thing to say is that if we have a strong deceleration of economy in the US plus tightening, much tighter monetary policy compared to the rest of the world in the US, probably you need to see some correction in the valuation, especially in the US, where a very strong part of the indices, 25 for the S&P, more than 30% of the Nasdaq are linked to GAFA, or very leveraged companies, so much more impacted in case of rising rates, obviously. So this is probably favorable to US asset compared to Europe, where monetary policy is going to be gentle compared to the US, where the recovery is still there, and so on and so forth. But there, what said Patrick is very important as well, is that probably what matters as well is the earning side of things. And there is a difference in favor of US assets, where we have this pricing power of a big US company, much more than it is the case in Europe. So the obvious call of outperformance of European assets compared to the US is maybe not that obvious. Obviously, rising rates is not very favorable usually to real estate market. Usually it's favorable to credit market, but it's not going to be the case because usually you hike rates when your economy is booming, while this time the Fed is very pro-cyclical. So we are more cautious on the credit market in the US, where US economy decelerating plus less buying by the Fed. Probably you rising unemployment and rising default rate, probably it's not very favorable to a credit spread in the US compared to Europe, where we still see 4% GDP growth, monetary policy, blah, blah, blah. I said it many times already. So a little bit of differentiation between Europe and US in terms of asset allocation that you can follow in our different publications.
Probably three things to complete and to conclude. Italy. I'm not sure really bond rates can go to 85 BPs because even though the ECB has the option of using the amortisements or reimbursements of PPP to support one country or the other, now we have like a 160-65 BP spread between BTPs and Bund. Not that easy to have that coming to lower levels. Now think of what the spread would be without the ECB. And you've got a country, Italy, with zero potential growth. The level of GDP in Italy is below 20 years ago, with a 165% debt to GDP. So what would be a spontaneous level of BTP Bund spreads, it would be well above today's level. So if 160 BPs is a normal spread between Italy and Germany, if you've got Germany going to 85, Italy will go to 2.5%, and 2.5% is above potential growth in nominal terms in Italy, which might start a problem with public debt of Italy. So I think we have a very big problem in Europe that is very different from the US. The Federal Reserve is not interested in maintaining the solvency of local and state and local governments. The ECB has to ensure the solvency of the different states inside the euro area. And of course, Italy is the weakest link here. With this zero potential growth in real terms. And again, I'm not sure Europe can afford having Italian rates going to 2.5%. So if it's the case, it's really putting a ceiling on German rates, which is not that far above where we are today. So this is something we have to look at more closely, I think. Second thing, just a global message, and François already passed it. Two global messages. Earnings growth in the US will keep strong, because we have this very big widening of profit margins we mentioned before. And this is offsetting the slowing down of the economy. I mean, so we, even though we see the slowing down of the economy, I think we should not be that pessimistic about US equities or credit in the US because of this very, very big improvement in profitability, which is continuing. And the last thing is a global message, is there is a tremendous difference on asset allocation depending on the reaction of nominal interest rates to inflation. If nominal interest rates increase more than inflation, which is what they should normally do, again, if central banks want to fight against inflation, they have to raise real rates, so they have to raise nominal rates more than inflation. Then in that case, of course, it's very bad for asset prices, it's very bad for property prices, it's very bad for equity prices, for infrastructure prices, whatever. But we are not in this framework. We are in an environment where central banks increase nominal rates less than inflation. So if you move back to real rates, if you look at the real rates, of course, today we have crazy real rates because of peak of inflation. But if you just look at the real rates at the end of this year, at the end of next year, they will be below where they were in 2018, 2019. So this is a very big support to asset prices. And it means that real assets are in this environment, in this framework, they keep being hedged against inflation. You can protect against inflation by investing in real assets because we keep very negative real rates. So having these soft central banks is completely changing the portfolio composition if you want to protect against inflation. Today, you can keep investing in equities, in property, in infrastructures, whatever. But the condition is that nominal rates keep increasing less than inflation, which is basically what we have in our scenarios.
So maybe we are closing to the time. So just before giving you my 3 point of conclusion, if you have any question, now is the time. On my side, just to maybe complement what Patrick just said, three things. It's very difficult to see some decorrelation. I was saying that this is something we look at for 2022, 2023, but in terms of asset classes, when we look at the different episodes of normalization, of quantitative tightening or interest rate hike cycles, you always end up with some different of beta, but not decorrelation. So I think 2022 will be the year of the beta, not of decorrelation. So to go along the same line of Patrick, in terms of it's a relative value story between the US stocks valuation and the European, between credit in Europe and US. But because usually when stocks are going down in the US, they're going down in Europe. When the rates are going up in the US, they're going up in Europe. The magnitude, the beta might be the name of the game for that. The second thing I wanted to say is that in this global environment, what is very, and Patrick just said it, we think it's very, very important to look at the real rates, real level of rates. And this is going to remain very, very accommodative. And this is absolutely of utmost importance to get that, because we are going to see a massive structural change going forward, where you had over a massive level of saving compared to investment, under investment in Europe, over investment in China, while we see this rebalancing and very big needs of investment going into the green transition going forward. And it takes low level of real interest rate to get there. Otherwise, it's going to be impossible to finance all these needs. So I think it's something really, really important to look at. And maybe the third element of conclusion is to summarize our view going forward for 2022, 2023. This is a year of normalization. This is a big picture, is that GDP growth are going back to not very different level of potential GDP growth, probably slightly higher for US, Europe, and quite lower for China, but we are back to GDP growth level. This is a year of normalization of budgetary policy. This is a year of normalization of monetary policy, even more, obviously. So normalization 2022, but as well, these differences between US, Europe, China, Japan. All these countries are having very different pro-cyclical or counter-cyclical monetary policy and very different position in the economic cycle. So if we do not have any further question for today, thank you very much for all your time and participating. If you have any question, do not hesitate to follow it through the team, the research team of Natixis. We will be very happy to try to answer it. Thank you very much for your participation.